Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his career for years. He's had an unbelievable amount of successes. He is a former hedge fund manager, the founder of Eclectica Macro. He's a St. Barts luxury hotelier, investor, and a surfer. Hugh Hendry, thank you for joining me.
I don't know if I'm a sufferer. I don't know if I'm pretending. I've not had very positive karma in my life in the last 12 months, and therefore the occasion to surf the waves has been less and less. But hey, thank you very much for having me.
Well, our listeners aren't going to see the beautiful view you have from either your house or your hotel, but it is wonderful. So maybe some of your trades recently haven't gone too well, but it looks like you're doing okay.
I get by.
So for the first question for the interview, in your opinion, which country has the worst debt or credit problems of any economy?
Oh, heavens. Any country outside the G7 or that's not part of the European currency bloc. So yeah, choose. Like I don't care. It's kind of like it's a tiny universe. What I want to say is that like all of the notable currency pairs, I don't believe any of them. I don't even believe sterling has an issue with the level of debt. I don't believe there's a relationship. I believe that macro history ended 25 years ago, and therefore I believe that observations relating the level of debt to GDP and currency weakness or strength are passé.
So you think then that by mentioning emerging markets, you think that the major theme then is dollar-denominated debt problem, and that the stronger the dollar gets, and we're recording this interview on Friday, June 2nd, 2023 for our listeners, dollar index is at 104. So then you think basically the stronger the dollar gets, the larger the margin call then on emerging markets and entities, either governments or corporations with too much dollar-denominated debt outside the United States?
Yeah, that would be correct. And the mechanism or the transfer mechanism for that would be the creation of US dollars outside the frontier, outside the sovereignty of the United States. That transmission of credit is conducted by the euro-dollar system. And I believe that even to this day, a lot of the collateral that is being pledged in order to receive US dollar credit is less than riskless. When I say riskless, of course, it's a somewhat jaded term, but riskless would be something we would associate with the US Treasury. So, with that hackneyed language, I believe that there are still credit counterparty agreements where overseas agents have borrowed dollars on the basis of, let's say, Italian BTPs, which is to say that the 10-year sovereign bonds of Italy. I think they've been pledged, and in return, they've received US dollars. And I think as the encroaching global economic storm gets closer and closer, I believe that the credit counterparties will demand that such collateral is replaced by US dollar treasury bills. I believe that every serious economic downturn has been preceded by a crisis in the collateral which has been accepted by the overseas banking community.
So the theme that's been going around the last couple of months, it was on Tucker Carlson. He was interviewing Peter Schiff. Luke Roman was getting TV spots, was de-dollarization. So what you just explained then, you're not in the de-dollarization rapidly camp then?
I am certainly not in the Peter Schiff or the Luke Roman community of hyperbole. I peddle logic.
Yeah, I agree. I think it's going to be very difficult for the global economy to de-dollarize. I mean, the trend is less, but it's not rapid. I mean, I've been covering this since 2008 or 2009, where people are like, the dollar is going to collapse. There's a petro yuan. They're going to abandon the dollar, and it just doesn't happen on any of the timescale that people expect. Especially when the dollar gets weak, that these foreign governments and these foreign corporations, they go and borrow more dollar-denominated debt every single time the dollar gets weak.
Indeed, they do. Anyone that perpetuates the de-dollarization categorically does not understand economics. They may be cute on television. They may be enjoying fellowship on Twitter and other social media, but they certainly do not carry credibility in my world, the world of professional risk-taking.
Well, we've been 15 years since the 2008 financial crisis, and I don't think there's anything close to a new system in place to replace the dollar yet. So I think that's been part of the problem. I mean, there's all these proposals for new systems, but nothing is scaling up in terms of cross-border trade settlement or anything like that that could replace the dollar.
Cross-border trade settlement is not the issue, and I could well perceive of more and more cross-border settlement in local currencies such as the yuan et al. However, that does not take us anywhere close to the vicinity of the de-dollarization. The world operates today in a highly unusual environment, unusual with regard to the last 200, 250 years of economic history, which is to say that the super industrialization that has emerged from China these last 40 years is being financed internally with a closed capital account. When the when the US economy industrialized in the 19th century, it industrialized running a persistent trade deficit, and it was funded by the surplus savings of the rest of the world. Contrast that with the arrangement these last 25 years, where China operates a closed capital account. So China and the trade that it offers the rest of the world is profoundly deflationary for global wages, because China supplies a profound surplus of manufacturing capacity. And the deficit nations, most notably America, run deficits, which is to say that they have a substantial import of said surplus in manufacturing. Imports are a subtraction from economic growth. That is why I describe it as deflationary. In return, the status quo is that China and other mercantilist nations purchase the financial assets of America. That leads itself to asset price inflation. So today, we're in the worst of all worlds. We have deflationary wages and we have inflationary assets, which of course, as the famous pop song or punk song from 3 decades ago, love will tear us apart. This form of trade will tear us apart.
Yeah, people who follow the Austrian school of economics is called the Cantillon effect. So the Fed and other central banks have just created distortions. They've intentionally, since the Alan Greenspan Fed created asset price inflation, they called it the wealth effect. I mean, they were openly promoting it for inflating stocks, bonds, and real estate, but this has really hurt the average everyday person who doesn't own a lot of those assets.
I am certainly no advocate or supporter of the multitude of sins and errors of the Federal Reserve. However, they are victims of their very own superpower. Their superpower is one of propaganda, and they've been very successful in persuading people that quantitative easing is the printing of new dollars. It is categorically not. It is the printing of inert banking reserves. Now, they have the potential to be made into money, but it requires a psychological phenomenon called risk-seeking proclivities by the American banking sector. And ever since the tumult, the crisis, the banking crisis of 2008, the community of American bankers has been somewhat circumspect in lending. That is not to say it has not lent. Clearly it has, but it has not lent in a manner which would explain, of course, the malaise of the high price inflation of the last 2 years. I believe that can be found elsewhere. But nevertheless, the Fed is being hung by its own rhetoric. It has this false premise that QE is money printing is coming back to haunt it. They've raised rates remarkably rapidly beyond the scope of their entire history. And I think that's a further error. But to conclude this section, the money printing is exclusively a function of the economic regime overseas today, where gigantic sovereign nations such as China run closed capital accounts. We are unable to buy their assets in any material manner. Their citizens are unable to sell their currencies and buy dollars. This is a centrally funded manipulation of the exchange rate, principally of the Chinese renminbi vis-a-vis the US dollar. In the last 35 years, China has emerged from a sub $1 trillion GDP, and today it rivals Europe, which is to say it is almost $18 trillion. It has enjoyed remarkable fortitude and skillful capital allocation in the earlier decades. However, its currency has depreciated over that period of time. It has gone from 6 to presently 7.3. In the laws of economic logic, it should have appreciated. It should have made its Chinese citizens richer and therefore able to buy goods and services from the rest of the world. Sadly, the economic policy of the Chinese Communist Party forbids that. And so we're left again, if I repeat myself, in the worst of all worlds, which is assets are beyond the reach of the common folk, and the common folk each year are being devalued. Labor is being devalued vis-a-vis capital. It must end.
Yeah, plus China created a housing bubble. I mean, like you said, a lot of Chinese that weren't super affluent couldn't get their savings out of the country. So they had limited investment options inside China. And one thing a lot of people did inside China was buy extra rental properties or home properties and speculate on real estate prices. And now it looks like they're going through a world record real estate bust.
Absolutely. This is an arcade of busts, if you will. But busts and poor asset allocation and losses eventually have to be assigned, and they have to be distributed within the domestic economy of China. And we know how that ends. It ends always with the personal household sector in China subsidizing the grave faults and errors of the bureaucrats in Beijing. And so we're looking at a world where you have financial repression in China. I suspect you will see it again emerge in the rest of the world. But that is to say that interest rates on savings in China are now negative and will remain negative. And that is a subsidy to bail out the local governments and the other financial agents which have been involved in a catastrophic error of judgment.
And I think that's one of the main demand drivers for physical gold globally is because of the policy decisions that the Chinese central bank, the Chinese government have decided with their housing bust, their currency. So if you're in mainland China, you don't have a lot of investment options. That's why physical gold demand for gold coins, gold bars, gold jewelry, it's different than a lot of the rest of the countries, the rapid pace of devaluation and the housing bust. So I think because of the closed, all the capital controls, the layers of that stuff, I think that's why demand for gold is so strong in China.
I disagree. I believe that is propaganda emanating from the Gold Council. I know your community are rather keen on the yellow metal, and at the end of the show, I'm sure they will detest me. However, again, may I repeat, it is a closed capital account. You are not allowed to transact in US dollars, and therefore Chinese citizens do not have the scope. I know people will be yelling, saying, yes, they do. Folks, they do not have the scope to buy gold. You've been sold, again, propaganda. Gold is not subject today to exceptional demand. Yes, central banks are buying it. Who cares? Okay, they sold it at the bottom. So is that do we care that they're buying it today? Let me tell you, whilst the numbers seem large, they pale in insignificance with regard to global financial assets, and they will certainly not make any difference to the relative strength or weakness of one currency pair where the government is accumulating gold versus another currency pair. I guess that is opinion, that is prejudice, but I do hope it is. It has the supposition of logic.
Well, we do allow independent and differing opinions on here. So thank you for stating that. I'm sure there's going to be a lot of people arguing with you in the comment section under the video. I want to transition now to the US banking system because you made a lot of mainstream people would say you made a lot of outrageous comments. But in your opinion, has the rapid pace of the Federal Reserve Bank rate hikes the last 12 or so months, do you think that that's made the majority of the US banking system insolvent?
Yes. I don't think I've. Please tell me the outrageous comments that I've made. I think you're referring to the fact that I suggested that we might have to assign a much higher probability to the notion that banking as we know it is no longer viable, that we've discovered that with the advent of telephone banking and the power of our iPhones, that deposits are now flight to capital, that there's no longer the inert nature of deposits, that money can be yanked, pulled rapidly. Obviously, the most notable recent example being Silicon Valley Bank. But if it hadn't been shut down on day two, 70% of its deposits would have been taken out of the bank. It doesn't seem possible that you can align that new development, that new phenomenon, technology bringing change to our world. I don't think you can align that to the investment in mortgages and industrial loans and other lending activity, which is typically of a longer term nature and requires a more solid footing in terms of financing.
I don't think your comments about the banking system are outrageous, but and I read a lot of the articles from Christopher Whalen and others, and I think he's a very conservative bank stock analyst, and he's even warning about the banking system also being insolvent. But I was watching when you were doing the Bloomberg radio interview, and they had the video feed of a moderator when you were making these comments, and Christopher Whalen was calling in, and he just seemed he didn't want to believe the stuff you were saying. But I mean, you were stating numbers and facts and stuff like that, and he just didn't want to. He didn't want to hear that the banking system was this bad.
Well, crises reveal the conceit and the arrogance of well-formed arguments. The crisis of 2008, which took us to the brink of the bankruptcy of the US banking sector. In March of 2009, Citigroup was trading for pennies. It was effectively bankrupt. Citigroup at that time was the JP Morgan of Jamie Dimon. It was of that stature, and therefore it was rather stark. The banking sector had been brought to its knees on the conceit, again, of a reasonable argument that the packaging of a geographically diverse portfolio of US mortgages would be almost riskless in its nature. And that argument or supposition was proven false when, for the first time ever, we saw nationwide price declines, and therefore we had a bankruptcy. This time around, the conceit, the arrogance, again, of a well-thought argument was that the banking community would be given the ability to hold US Treasuries without the burden of having to mark to market either gains or losses, but obviously losses being focal in the decision-making process. They would not be marked through the income statement. That has been proven again to be a disastrous decision, because with deposits seeking higher returns owing to the Federal Reserve's rapidity in raising rates, banks are being forced to crystallize their hold to maturity portfolios. They're being forced to sell those securities to match and meet deposit outflows. As they sell securities which had been previously designated as hold to maturity, they crystallize unexpected losses. And that brings into question the solvency of the entire banking community.
So with Dodd-Frank, when it was passed in 2010, there was a ton of YouTube videos and people were going through the legislation talking about bail-ins, that the depositors would be screwed over. We saw with Silicon Valley Bank that within a couple days, the rules were changed again. Do you think that they will go for bailouts for regular depositors under 250,000 or whatever the maximum number is from the FDIC? Or do you think that bail-ins were just a myth with the laws and that the people in power here in DC won't follow the bail-in laws?
I believe that the flight of deposits out of the banking sector is not principally motivated by a fear of the deposits being uninsured. For sure, there was an element of that. But I think the continued flight of deposits from the sector is a function of the Federal Reserve offering you 5.25% interest rates, and the banks being unable to match that. Why are they unable to match that? And indeed, why is it unprecedented that the Federal Reserve should raise rates by 500 basis points in such a short period of time? The reason is that the loan book, which is the principal asset of the banking sector, it reprices slowly. And so in previous hiking cycles, the Federal Reserve, which after all is the regulator and the overseer of the community, is very cognizant of that risk. And therefore it's very predictable, but it's very slow and cautious in raising interest rates. That has not happened this time around. And therefore the banks are being forced to pay more. And as they do so, their net interest margins, which is to say their profitability, is substantially impaired. And again, all roads lead us back to questions regarding the solvency of the banking community.
So you're saying that people are pulling money out of these regional banks for greed reasons over fear reasons. So rather than being worried that they're going to get screwed over in a bail-in or FDIC limits, they're going for greed reasons to Treasury Direct or to money market funds for higher yield.
Yeah, I don't quite like the term greed. I mean, it seems loaded with prejudice, but for economic rational reasons, they're seeking a higher risk-free rate.
I want to get your thoughts on commercial real estate. Do you think that this is going to be one of the largest, if not the largest, commercial real estate busts in U.S. history?
It has that capacity, yes. It is, to use the language of Donald Rumsfeld, it's a known, if you will. Typically those portfolios are trading today at substantial wides or discounts to their former marks. However, it is being tantalizingly held together by the fact that we're not seeing a great deal of transactions which would verify the lower prices. There's something of a paradox in today's market. In today's market, we're still seeing the blow off in non-farm payrolls, and with the advent of AI and the excitement that it's breeding, we're seeing stock prices which don't want to go down. So we have stock prices that don't wish to go down. We've got interest rates set by the Federal Reserve, and it would seem, don't wish to cut for the time present, and they're being advised to raise rates. The longer that situation continues, I fear the sooner we reach a point where economic agents in the economy, feeling adversity, find that they have no choice but to transact. And once you see a rise in commercial property transactions, I think you will see a lot of pain and distress. Again, we come back to questions of solvency. I mean, we've lost 3 or 4 banks before the credit risk, which always emerges with a recession, has materialized. I mean, that's quite a profound statement. We've lost large banks. These are amongst the largest banks in history to fail, and they failed before the advent of the economic downturn. Consider that.
For additional collateral damage for the rapid pace of these Fed rate hikes, losses on bonds, problems in commercial real estate, do you think that the insurance companies and pension funds are going to have potentially as bad or worse problems as the banks?
They're going to have problems. Financial assets, I think, are resetting. There was a fictional element attached to asset prices, which was created from perhaps an exuberance of money to buy such assets, and people were overestimating growth rates and underestimating the risks. As those errors of judgment come to light, then asset prices have to reprice lower. Don't get me wrong, I'm a buyer. If we got a 20-30% downdraft in the S&P from these levels, I'd wish to buy. But presently, I fear the risk that we do witness that regression in the mean is such that I wouldn't wish to have a great allocation of capital to any risk asset at the present time.
So you have a pinned tweet on your Twitter from March 3rd, and it's talking about I would say a model portfolio. It's not investment advice, but you're talking about 55% long treasuries, maybe a currency pair shorting the Chinese yuan, exposure to cryptocurrencies, maybe Ethereum and Bitcoin, mix of stocks, 20%, a little bit of gold. And then I know you've talked about Bitcoin. Do you still believe in that portfolio allocation, or do you think based on the Fed rate hikes the last couple of months that has changed?
So the portfolio that you're referring to is an attempt to try and widen the knowledge of investment. Professional investors typically think quadratically. They think, if you will, of the 4 compass points, and it creates 4 zones on the compass. And investors typically seek an exposure in each of those quadrants. They do so because they do not want to overtrade their portfolios. The best thing you want is to try and have a degree of diversification, which allows you to move from point A to point B, and perhaps the distance between them is 6 months before you have to revise your thinking. Hopefully it's 12 months, hopefully it's 18 months, but you have that ability to revise your expectations as the facts change. With regard to the March 3rd versus today, I had, I want to say, a 20% allocation to equities. I think that's the manifestation of my concern that I express for risk assets. The equity portfolio was almost exclusively commodities, and that was an exposure to uranium, gold, agriculture, the broad diversified metal stocks like Billiton. I recently tweeted a change to that. The portents of the economic downturn seem so great that actually I don't feel inclined to own them at the present time. So 3 months has passed, and I'm making a little change. Again, I will shock people and destroy my credibility with your good folk, but there is a bubble emerging in AI. I've been around long enough, and I don't believe you should run away from bubbles. I don't believe you should call them names. I don't believe you should guffaw that NVIDIA trades on 25 times revenue. If it does so, then it could trade on 30 or 35 times revenue. Bubbles are fantastically curious places for modest investment allocation. All of my investment ideas have the legitimacy of a price trend. And so the 7 stocks, the 7 wonder sisters of the S&P, which account for all of the year-to-date gains, find themselves with that very, very strong upwards price thrust. And so I've changed my equity allocation to favor those names. I modestly, if you will, in the sense that I've held money back because we had an explosion in NVIDIA earnings this week or last week, and the price gapped higher. I can well imagine that coming back somewhat, but if it did so, I'd be a buyer. My largest NEV exposure would be to those treasuries, but the realized price volatility, of course, in treasuries is well, it's similar to gold and it's similar to treasuries, but it's perhaps 1/3 of that level prevailing in Bitcoin. And so it's a large NAV, but in risk-adjusted terms, a more modest position. Also, I must add that my position in treasuries just now is exclusively a position in very long-dated at-the-money call options, extending to the year 2025. I cannot commit myself to a directional Delta 1 position today because the price has yet to establish a price upwards thrust. So I have an asymmetric absolute known loss if my thesis is wrong. Therefore, I don't fear being wrong. I can live with the consequences. But if I'm right and the thing moves, then I've got a profit source which can allow me to expand my risk position. I think that's most likely turn of events over the next 3 to 6 months for that portfolio. Bitcoin is a 20% exposure. Bitcoin has lost 60% of its value. And I can purchase Bitcoin within a very loathsome, a very unappealing investment structure, the closed-end fund of Grayscale. It trades at a 40% discount to NEV. So something's fallen 60% and I can buy it 40% below the mark. And I have an idiosyncratic catalyst. It may come to pass, it may not. But I believe that in the fullness of time, fullness being the next 3 years, I could imagine the structure of that fund being transformed into an ETF, and the discount at least would be eliminated. My reasons for my biggest risk exposure being Bitcoin is that we find it in, I said to you, 4 corners of a compass. We find it in a quadrant that we refer to as the alternatives. I believe there's about $100 trillion of alternatives, which is to say that the $12 trillion of gold, add on silver and the other precious and the palladiums, etc., throw in treasury, index-linked securities, and throw in commercial property, I think, and private equity. Altogether, it's about $100 trillion. I'm not of the expectation that $100 trillion, I can see that shrinking in the next 5 years. But within that allocation, I think it's conceivable that something which is 0.5 trillion could easily be 2 trillion. Whereas I find it really hard to imagine that gold could trade 3 times higher, 4 times higher. If gold were to trade 4 times higher from today, it would have the same capitalization as the US securities market. I know there are many who have an ardor and a love affair with gold, but I can't conceive of gold being valued at $50 trillion. Maybe I'm wrong, but I can conceive of Bitcoin trading with a market value of $2 trillion. That is my speculation. And like you say, the fourth quadrant would be cash. And within cash, you can have currency pairs, and the persistency and the ignorance with regard to the damage that the Chinese are doing leads me to believe that the trend will only be for further devaluation in their pair versus the US dollar. And of course, all of my portfolio doesn't consume all of the cash, and therefore my cash would sit there earning, between 4.5% and 5% in US cash securities.
Do you think that oil will have a rally in the next couple of years? Because we're just seeing on the futures market record short positions over the last, I think it's a 10-year record now for short position of oil futures contracts. The rig count's falling. A lot of the oil production is much higher cost than it was 10, 15, 20 years ago. And the largest oil production in the US, the Permian Basin, looks like it may be peaking. So it's looking kind of bad here for the supply side for oil. But if you talk to a global macro hedge fund manager, it seems like most of these guys are all very heavily short oil and energy right now.
Yeah, I mean, you described a situation where the supply side is questionable. What does that say about the demand side? Because, the price is slipping. The price of oil and the price of copper is confirming my worst fears that the folly of the Federal Reserve is about to unleash a profoundly savage economic downturn. And I think that's what the price of today, that's what the price of oil and the price of copper are telling you. That is not to say that we will not at some point reach a bottom. I pray for that day, and I hope that I can be smart enough to make an allocation at the lows. We shall see, but I'd rather avoid the journey from where we are today to where it may have to trade as the economy weakens.
Do you think the Federal Reserve and other central banks and the governments that back these central banks will actually allow deflation and bankruptcies for a long period of time without more rules changes, interventions, bailouts? Because it seems like things are kind of headed towards the last 30 minutes we've been talking deflation, bankruptcy, higher interest rates, businesses can't pay, either they sell out or go bankrupt. That's deflation and bankruptcy, free market forces. So do you think that they will actually allow a long period of deflation and bankruptcies?
But that's to presume they have power. And that's to presume they have wisdom. And that's to presume that they're being advised by smart people, smart, objective people. And I don't think any of that applies. The principal thrust of deflation in the real world and not the financial community, again, to repeat myself ad nauseum, is the predatory nature of beggar thy neighbor policies coming out of mercantilist nations that run perpetual trade surpluses with the rest of the world. The drama, which is now being predictably resolved around the debt ceiling, is just a grotesque manifestation of ignorance. With the present economic alignment, debt has to rise. The only source of economic growth is debt expansion. There are three components to GDP growth. One is population growth, one is productivity, and one is debt. Population growth, I don't think you need a bozo like me to say, it's flat, it's zero. Some parts of the world is negative. Productivity is a mystery. I feel like our productivity is far greater. We have these supercomputers called iPhones, which have changed our life, but investment levels are very weak, and we're not seeing productivity. So the GDP growth is a function of debt growth. China et al. Provide the, if you will, the lender financing, so that the good folk in America buy the surplus of manufacturing capacity that the Chinese have. If you want to resolve, the debt ceiling, you've got to close the American capital account with the rest of the world, which is to say, you've got to make it harder and harder for overseas sovereign nations to accumulate financial assets denominated in US dollars. Until someone in Washington discovers that, debt will continue to rise. Why are they not discovering it? Because the present trade arrangement creates and fosters asset price inflation. And who makes money from asset price inflation? Wall Street, and money buys votes. This is the world of the Wizard of Oz. Wizard of Oz being the allegory of the US elections, two hard-fought elections in the 1890s. William Bryan Jennings, an incredible orator. He is the lion in the movie, an incredibly fearsome speaker and a wonderful speaker. And he was arguing for the establishment of a bimetallic monetary standard to bring in the plentiful supply of domestic silver to enable the banks at that time, who were tapped out, to give them the credit momentum that would reach and refloat many corners of the American economy. A very, very compelling and sensible argument that got nowhere. He was the lion with no claws. He was the lion with no roar, because all of the power was held by the witches on the East Coast, the metaphor being the JP Morgans of that time. And of course, we have Wall Street today.
And I think the city of Oz was supposed to be Washington, D.C., right?
Indeed it was. And everyone was forced to wear spectacles that made everything green like the dollar greenback.
It's just a wonderful political allegory. I mean, in the movie, they changed Dorothys' shoes, I think, from silver. In the book, they were silver, and then in the movies, they changed them to ruby red because they didn't. I think that was the first movie in Technicolor.
That's correct.
There's a documentary on this, The Secret of Oz, if our listeners want to go check it out. It was done, I think, 10 or 15 years ago. It's an excellent documentary. So the scenario that we've just talked about the last 30-something minutes, it sounds like there's going to be, if the central banks either keep interest rates at these levels or raise them, there's going to be deflation. There's going to be bankruptcies. There's going to be a lot of problems. Do you expect then central banks to resort back to the old tricks of financial repression and start cutting interest rates then in the next not too distant future, or the system potentially then could collapse under its own weight with debt?
It will presently collapse. The economic recession that I foresee is a function of the raising of the carry on the substantial debt load of the economy. The debt to GDP is on a historical par with the end of the 1920s and the beginning of the 1930s, when we got to about 3.5 times debt to GDP. Society took 40 years to deleverage, and it deleveraged largely through the notion of financial repression. If you've got such a huge quantum of debt versus GDP, the only way that GDP can narrow the gap is if you do a wealth transfer from the creditors to the debtors. Now, yeah, there's a lot of good folk with savings, and moving forward, they ain't going to get paid as much. The quid pro quo is that, the guys and the girls that change the world from their garage or their basement, that have ideas but have no funding, they're going to get cheaper and cheaper funding. So paradoxically, we were well set. I'm not an advocate for high asset prices, but if the government is ignorant of the damage being wreaked on the common folk by the closure of the Chinese capital account, then the only way you keep the system alive is by having zero or negative real interest rates. On June the 12th, the government will publish inflation statistics. I know what they're going to say. They're going to say it's 3.7%. Inflation is falling everywhere. Fed rates are 5.25. So interest rates just now are well in excess of the natural rate. This is why we have an inversion in the bond yield curves. And this system will crash and burn for as long as interest rates are maintained with a positive bias. So I foresee that in the not too distant future, the Fed will do a mea culpa and it will rapidly be cutting interest rates again.
Do you also expect the Fed balance sheet to have to increase? Because you talked about China and vendor financing, but if we look at the numbers, the usual net buyers of US Treasuries the last 20, 30 years are China, Germany, Japan. They're not the normal buyers. So do you think then the Fed will have to pick up the slack of Treasury buying in the future?
No, I don't. I believe that the re-onset of deflationary forces will inspire a great deal of fear amongst private sector investors. That fear is already manifest in the fact that there are only 7 stocks rising in the S&P. Any other stock which is deemed to be infected by cyclicality, by economic risk, is largely trading sideways to down. We have 7 stocks which are regarded as riskless in that they have very little association with the tribunes of the economic cycle. The legendary Stan Druckenmiller owns NVIDIA because he's saying in every great bear market, there was a tiny percentage of stocks which were deemed to be that could rise above the malaise of the economy. You had, in the 60s, you had defense stocks. In the 70s, you had oil stocks. In the 80s, you had consumer defensive stocks. And perhaps we're seeing that play out in the Microsoft, Amazon, Google, et al. Today. So I think the further spread of risk aversion will create an enormous appetite to buy US Treasuries. And then finally, if you remember, I was saying to you as we started this conversation, we were discussing the euro-dollar system. The system, it's effectively a pawn shop. You have to, if you provide collateral, then overseas banks will create new dollars as credit to you. And I'm saying to you that a lot of that collateral is not US Treasuries. And as the economic storm clouds gather force, that the counterparties will be insisting that unless their customer presents the collateral of US Treasury bills, their credit position will be closed out. So I can well imagine other assets being sold to create the funds to own treasuries, which they can then replace as their collateral to maintain their credit lines. So I'm not a believer in the scare story of the great deluge of supply, which is going to crush the treasury price. The treasury price has fallen 50%. We have wiped out 15 years of price gains in US treasuries. That is an environment, bottoms are an environment which are full of scarce stories, such as the supply story.
What worries me the most is actually that DC really, when they're talking about debt limits or spending, I mean, there's very few people in either political party that want to actually cut spending. I mean, they're really just fighting over the increasing rate of spending at this point.
I'm not sure they are, I'm really not sure they are. They fear the debt ceiling. The Democrats, even within their own party, were forced to scale back their remarkably enormous, fiscal splurge during COVID. If we look overseas, the British government has again adopted the disastrous policy from 2010, where it constrained public spending. It cut the wages of nurses and other public employees. So I'm not quite sure that we live in a world where Japan et al. Have demonstrated. What do I want to say? I want to say that Japan's gone from 40% debt to GDP to over 200% debt to GDP, and that's occurred over the last 30 years. And it's only been the last 12 months where the currency actually has come under any pressure. But yet, fiscal conservatism still seems to carry some attraction to the folks in Washington.
Well, it's different, though, because Japan was the only large country doing Japanification, yield curve control, allowing hedge fund managers and portfolio managers and investment banks to do yen carry trade for a while. It seems now a lot of these governments said, oh, Japan got away with it for so long. That's a good idea. We should copy Japan. But can all the governments do what Japan did at the same time for a long period of time?
Ivans, you really are talking to the wrong folk. When I was managing my hedge fund, I didn't take calls. I didn't take calls from brokers. They fill your head with these fantastical stories. The only influencing factor in Japan is that it has suffered 3 decades of a depression. Okay. I don't believe there's a manipulation. The fact is that prices have been falling in Japan for 3 decades. There is no appetite to take commercial risk in Japan, and therefore all roads lead to owning the riskless security, which is the JGB. Now, paradoxically, however, the bogeyman of quantitative easing, the money printer, it's a fallacy because it's a fallacy until the banking sector gets the courage to actually want to use it to expand credit. And that hasn't happened anywhere. Well, except, however, perhaps in Japan, it's a supposition. It's no more than a supposition at this point, but it would seem to me that in the last 10 years, the Japanese huge money center banks have followed their largest business clients in investing in mainland China. And of course, that was the accepted belief system. China was the future. China was doing something special, more special than the rest of the world. And I do fear that when I talk about the repo or the pawn shop, which is the Eurodollar system, Japan presented to its other banking counterparties trillions of yen worth of Japanese paper, and effectively it borrowed or it went short US dollars. And then it took, with those dollars, it made commercial risky. Commercial is risky. And they made commercial loans to mainland China. So they've been short the dollar with short tenors. It's every 24 hours they have to roll those contracts. They've taken kind of like 10 plus year loan investments into China. And on top of that, they have taken on commercial idiosyncratic risk. I think the profound weakness in Japan in the last 12 months is more a function of the unwind of their banking counterparties insisting that the Japanese banks have to produce US dollars. So you have to buy US dollars, you've got to buy US Treasury bills. And that's what I think we're seeing in the persistent weakness of the dollar yen rate.
But correct me if I'm wrong, didn't the Bank of Japan sell a large amount of US Treasuries a couple of months ago? They sold about $90 billion in a month. So weren't they net sellers, or you're saying they're net buyers? I mean, I haven't seen the new data, but I thought they were net sellers.
Yeah, I mean, a man with a hammer goes looking for nails. They are one of the largest holders of sovereign US Treasury bonds. Likewise, the Chinese. Now they own those securities. They're not hedge funds. They are not seeking a commercial profit. They're not seeking 2 and 20. They are seeking to stabilize and protect their economy. They know that their banking system is underpinned by this euro-dollar phenomenon. And they know that there are moments of stress where dollar treasuries become scarce and unavailable. And at those times, the insurance protection of owning US treasuries by the sovereign means that they are able to bail out their banking sector by selling some of their treasuries. 90 billion sounds a lot. It's nothing in the world of trillions. They sell those securities and they pass it as collateral to help the banking sector.
Okay, thank you for explaining that. Do you expect record asset price volatility then based on central bank policies and for years to come?
Well, the persistent march higher in government debt to GDP essentially creates what we call a volatility machine. It makes the world more uncertain and more subject to these profoundly wild vicissitudes. We had the NASDAQ collapse from the bubble as we approached and entered this new century. We had a principal stock market index which lost 80% of its value. Typically, with the data set, you would assign a kind of 1 in 100 year type probability to that, and it happened. And it was 70 years since it previously happened, so it kind of rhymes. But 7-8 years later, we had the debacle and the bankruptcy of the US banking sector, which is again typically a 1 in 100 year type event. So we've had two, and then we had COVID. And then God knows what's going to happen in the next 12 months, but it's going to be rather fearsome. So the volatility is a function of leverage because no one seems to have some sense in terms of trying to address the trade issue. The debt's going to rise, and therefore we're going to get more of these vicious economic downturns.
Stanley Druckenmiller just put out another set of warning videos. I know he's been doing this for a while now, but if you look at 3 or 4 of the US federal government's main expenses, their line item expenses, interest payments on debt, military spending, entitlement spending, I mean, it's taking up a large chunk of the tax revenue. So your position is you don't think that that's going to hurt US Treasury demand or strengthen the US dollar?
What do I believe? I believe that the strength or otherwise in the US dollar is not a function presently in this economic environment of debt to GDP. Debt to GDP in America, I think, is like 110, 120%. I think there's 30. I saw the debt clock. It seemed to say $32 trillion. The economy is $23 trillion. So maybe the ratio is a little bit higher. But it can rise. The corrosive factor is the interest rate they pay on that debt. And because the Fed has endured this folly of the last 2 years, the cost of servicing that debt is very high. So it is within my imagination to believe that the Federal Reserve will be cutting rates perhaps all the way back to the much feared ZIRP. We may have to go all the way back to zero. I own treasuries because I believe we're going to see rates fall substantially.
Well, I really enjoyed our conversation today. I want to thank you so much for your time. Is there things in the economy sectors or technology that you're actually bullish or optimistic on?
I would hate for you to think that I'm pessimistic. I'm a strategic and hopefully judicious allocator of risk capital, and I enjoyed 15 years owing to being judicious, smart, and cautious. There are times when you party and you drink champagne at the roulette wheel, and there are times when you stand outside having a cigarette. And this is one of those times where you're outside. If you're European, obviously, if you're American, what I just said is tantamount to being shot. But
Well, I think some of our tobacco companies now are marketing themselves as ESG. I mean, I don't understand it, but apparently they hired some marketing people to spin it that they're ESG now.
The world never fails in being fascinating.
Or hiring overpaying marketing professionals. Look at what's happening with Budweiser and Bud Light. Now their sales are collapsing.
Yeah, well, I mean, I do believe that. I actually believe that I don't believe there's any historical precedent for hyperinflation in an economy where publicly traded government securities was such a very large percentage of the economy. I think it acts as a fire break, that the market is very rapid to reprice the cost of credit. Previously, the Fed had to be slow, owing to taking small measures in order to protect the banking sector. If you think back to the taper tantrum of 2013, we had adult unemployment of almost 7.5%, and the private market, Bernanke shouted fire in the cinema, if you will, and the 10-year was repriced within months from 1.8 to 3%, and the economy hit the buffers. Up until COVID, the central banks had been abysmal in trying to reach the modest target of 2% price inflation. And I think for that very reason. However, the fire break, I think the only vulnerability to the fire break is this notion of psychology that, if risk allocators just finally conclude that the entire system is chaotic, then kind of the rule of contract law and things kind of goes out the window. Citizens kind of want to fight with each other within their sovereign nation. The media seems to suggest that we're in one of those periods, but I think a wiser review of American history, I think you can find that is always been a church of contested opinions. But I fear with the upcoming presidential election. And again, I'm just going to sound like a doomsayer, but the thing that I fear more than anything else is an attempted assassination of a prominent US politician. God forbid, that's not a prophecy, but it's a thing that I fear. That's historically, if I think of Germany, there are many reasons that contributed to the Weimar hyperinflation. But the assassination of that rare bird, that politician that actually could unite all of the disaffected and arguing souls within Germany, when he was taken down, anarchy pursued. And markets, therefore, just were not a fire break. So I hope I'm wrong. But these are the things that one has to consider.
I don't think a reserve currency is hyperinflated in history yet. Now, I know they've been debased pretty rapidly, but not a modern world reserve currency. I don't think they've been hyperinflated. Normally, hyperinflation's and I know you've studied financial history the last 130 years. Aren't they from war reparations debt in a foreign currency? So foreign debt, so the local government cannot pay back the debt in their own currency, or it's from lately, the last couple decades, since the 60s, 70s, 80s, it's been dollar denominated debt. So an emerging market gets in trouble, borrows too much dollar denominated debt. The dollar, the dollar has a rally, their own local currency falls, and then the emerging market gets in trouble. And that's when the emerging market hyperinflates.
90% in agreement, except there has never been a reserve currency until the dollar. The dollar is the first reserve currency. You might come back with the retort of British sterling, but by British sterling, people were willing to own it because they felt that there was a very solid flowback relationship to its gold and silver holdings. We were on a hard money currency, commodity-backed reserve system. This is the first time ever that we've been on a fiat reserve currency called the US dollar. I think that if gold was the underpinning of the gold standard, clearly, and then I think US Treasury bonds are the gold of yesteryears. The gold standard was brought down because it wasn't elastic, that it couldn't be expanded. Again, to the Wizard of Oz, the bankers were constrained in lending by the absence of additional gold in their vaults. We don't have that issue. Modern democracies, we sent a lot of poor folk into many global conflicts, and they demanded that the system be less philosophically harsh at times of stress. Reserve currency, back to this profoundly ridiculous presumption of de-dollarization. Reserve currency only exists when large communities overseas resist the purchase by foreigners of their own domestic assets. So it's not trade settlement. It is the fact that if you're a Brazilian iron ore or soya producer and you've just sold $1 million to a Chinese customer, and your government has concocted this intent for you to receive the yuan in compensation, what are you going to do with the yuan? You cannot open a bank account in China. You will not have Brazilian banks offering you yuan accounts in Sao Paulo. You can't buy a Starbucks in Sao Paulo with yuan. So you're going to buy US financial assets. Until that stops, the predicament of today will be particularly acute.
And the U.S. can keep on doing the same policy. I don't like any of the policies in DC. DC is just a mess these days with both political parties with the spending, but it seems that the system is going to continue for a while.
Yeah, the system is exogenous. It's not endogenous. The debt ceiling is a function of the behavior and the activity of foreign sovereign agents. The debt goes up regardless of the jawboning between, the opposing political factions until they reunite and recognize that, the threat is not one or the other, but it actually comes from overseas. But, Wall Street is hiding its dirty little secret.
Well, I really enjoyed our discussion today. Do you have a newsletter that my listeners can sign up for if they want to follow your work more?
I have a Patreon service, and I have a podcast, the Acid Capitalist podcast, which is out there on all the major audio platforms. I record it on YouTube, Hugh Hendry Official, and I become a somewhat addictive presence on the Twitter, when you can find me at Hendry_Hugh.
I want to thank you so much for your time today. I didn't agree with everything you said, but I think I learned a lot. So I think my listeners will really appreciate hearing your viewpoints.
Direct your ire, your disdain at me. I've heard it all before.
Well, that's what makes a market, right? Because if everyone agreed on everything, then markets wouldn't go up or down or sideways all the time. So
Exactly. Well, thank you. Excellent.